All right. Welcome, everybody. Today is July 7th, 2025. My name is Spencer Riegle. I am the Chief Crypto Options Trader and Strategist at DARMA Capital Trading. We hop on each week and we talk a little bit about markets, some market outlooks. We also talk a little bit about macro and what we're kind of seeing across the board in markets. So you can follow me on X at _ my last name, so RIEGLE, or you can follow us at DARMA Cap Trading. We're becoming a little bit more active on there. So we release some outlooks. We also release some education. We have a full education suite for free. So make sure to check that out as well. And then the last place is, if you're on LinkedIn, add me on LinkedIn. And I am fairly active and responding there as well. So without further ado, let's hop in. I know we're starting a little bit late, but let's hop into the disclosures first. So all information and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. So each week we hop on and we talk about risk first, right? And so what we always talk about is risk capital. So capital in which you're willing to risk, and what we deem as risk capital is capital in which you're willing to lose, right? And part of the reason for that is a couple of reasons. Psychologically, if you are thinking about your bills, if you're thinking about ends meet, if you're thinking about just a better quality of life, maybe a gym membership, and that all of that psyche goes into the trade evaluation, goes into your thought processes, that is going to impact your bias. And what we like to focus on is the facts, right? And so if you already are coming in with a bias of you need to pay for this, or you need to do this, or you can't lose because of this, that's not a good place for you to be or think logically, right? And so that's why we start each week talking about risk capital. Another piece here, so we got a little bit of house cleaning to do. So this is the Bookmap stream. So they are offering a 4th of July sale, and it is up to 50% off on Bookmap Global and Data, and that's offering is going to be for the next 4 days, right? So until July 11th. So make sure, if you're interested in that, go check it out. The next piece is they are kicking off their Pro Trader webinar series with how to use Bookmap's liquidity heat map, right? So get in the Discord and check that out as well. There'll be a lot more information in there as well. And then if you are in the DARMA Capital Trading, feel free to reach out there in that channel, and we can go through some of that too and get you the correct information. Last but not least is we always like to start the stream talking about our website. So if you have yet to see it, dharmacapital.trade, everything in which we do, from advisory, analytics, academy, to even about us, right? And so there's a lot of free stuff as well on the website. So let me blow it up. Head over to the sign up page and head down to the free trader assessment and education. We have a very large free educational suite. Make sure to check it out, as well as free education on tons of the analytics that we're going to talk about here today, and then trader assessment. So getting to know yourself as a trader a little bit, and those certain biases that potentially you bring to the table, or certain environments in which you would operate better in. All right, so let's zoom back. So for those that are new, usually we start the stream and we talk about top-down approach to markets, right? So we take kind of a sky approach, kind of a bird's eye view to markets, and we look at the macro events. So what's kind of going on in the world? How is it impacting markets? And then how is it going to impact the markets that we talk about here, right? As you are probably familiar, most markets are correlated, and the liquidity in the markets is absolutely correlated, right? So you can think of a market as kind of like a channel system or a lake system, right? Where that water flows through, and all of these different dams that are across the globe impact that water supply and impact where that money can go and buy and sell goods and stocks, equities, futures, etc., commodities, all of these things, right? So that's kind of how I like to think about it, and that's always why we take a macro approach first when talking about it. Another thing to note is we are in the beginning of July. So summertime volatility is notorious for being lackadaisical, and that's kind of what we've seen over the last week. Obviously, it was a U.S. holiday, so locally here in the U.S., we celebrated Independence Day, and towards the latter half of last week, volatility has just basically non-existed. The ES, the S&P 500 Index Futures, has just clocked. It's about just clocked its first down day in 10 sessions. So this is 9 straight sessions of positive growth, and today is the first decline, right? Why the decline? From some of the news outlets and all of the talk today, the U.S. administration is continuing to talk about tariffs, right? And so July 9th was that initial tariff deadline. They are pushing it back to August 1st. However, they are going to be reverting those tariffs back to Liberation Day, right? So all the way back to those April tariff readings that Trump notoriously used a board to kind of portray, right? And so markets are a little bit jittery on that. However, if you listen to Besant and you listen to kind of the commentary out of the administration, it does not seem to be a hard deadline. They are trying to play hardball, and they are optimistic that trade deals will come through, right? And specifically, there are 18 countries that actually they're pressing, right? That actually matter, that are large trade deals, right? And so a couple things to think about when as we go through more trade negotiations and as this kind of lags, right? Jerome Powell's stance on rate cuts has been that he would have cut prior to present day, except for the administration's tariffs policy, right? His largest concern, and the Federal Reserve's largest concern is that these tariffs will have a lingering impact on inflation in the United States, right? And so their mandate is to bring down inflation, but also bring back price stability, right? And so they are acting or trying to act independent of the U.S. government. However, they are also feeling pressure, and Trump is also making his points be heard. However, they are staying in their lane and kind of putting their heels in the dirt, right? And so with a jobs reading that we had last week, which was positive, gives them grounds to kind of hold, and that September rate, that rate cut in September makes a lot more sense than a July rate cut, right? So that is kind of what's going on. Another thing to think about is as these tariffs talks prolong, it seems as if the words good faith are being used, right? So August 1st is a hard deadline from the U.S. administration. However, they are saying if actors or if countries are acting in good faith, they can be a little bit lenient, right? And so as this lingers, how impactful does it become to the economy, and how are things kind of impacted is the biggest piece here. Obviously, on the risk side of things, if some of the larger trading partners start to play hardball once again, and there is global uncertainty, that is not going to be positive for equities and risk-on markets, right? And that's kind of what we saw a little bit today with declines, and we're showing red basically across the board in the index futures. So there's not much else going on outside of that. It is the middle of the summer, and likely things will start to pick up, but not here in July. So we'll see what August brings, but the expectation is for a slower kind of July, and we'll see kind of how we progress through this quarter, and then we go into the fall time. All right, so let's pull up some weekly outlooks. So the next piece that we talk about is, after kind of going through a macro outlook of what's going on in the global economy, now we dive into kind of more of a intermediate term, and for most it's actually a very short dated term, which would be a 7-day weekly outlook. So we cover mostly Bitcoin and Ethereum markets when we hop on the stream. However, you'll notice that on our website, which I am going to talk about the outlooks, we support all of these asset classes along with multiple different tickers and symbols within each. So let's hop over and let's talk about Bitcoin first. And there's a couple things. Now that we've launched our playbook, we can actually just read straight from the playbook, and we can talk about the weekly outlook. So let me pull up the weekly here. And what I have here on the left side is price map. So price map is our proprietary data and analytics. You'll also see the market state, structure, strategy, options, and then our score. These are all different tools within the price map that we use to better make decisions, right? And so that we talk about. And then on the right side, you can see as well, I have the Bitcoin perpetual multi-book with Bookmap. So first we're going to talk about the playbook, and then we're going to hop into Bookmap and look at where that liquidity is, where that alignment is, so that we can make better decisions and see where things are more on a micro scale. So each week we like to start out at the directional, right? And so that directional is defined by 108, basically, in $16, right? So 108,016.70 cents. Over it's positive in terms of price, under it is negative. Sentiment, you'll see here, the R level down here at 104,284.60 is where the expectation is. If the market breaks, this level should hold. If it doesn't hold, then generally this becomes a hedge theme, and this becomes a market that is not in a uptrend, right? And so let's dive into the market state here. Currently, this week, we have a bull trend market state. So this is a signature state. So a bull trend is a signature state, is typified by a market that continues to make higher move highs and higher move lows, or positive structure. If the market continues to hold structure, further gain should be expected. This does not mean there cannot be a corrective setbacks, but rather any negative price action is expected to exhaust above the lower inflection point that will maintain structure. Any failure or break in the positive structure is more likely to produce a neutral shift rather than a negative transition. A quiet market is likely to turn positive, especially later in the trade period. Typically, if the market is going to trend higher, it will demonstrate that with positive intraday price structure. If not, a firm digestive trade is the outlook, right? So this is the market state. Market state defines kind of where we're at, where's the trend at, right? So we've talked about some bull trend corrections. This week we're in an uptrend. So the expectation is for the trend to continue, higher highs and higher lows, right? The structure with the R level at the DP, the sentiment bias is positive, right? So we just talked about that. But the R level equal to the downside pivot defines the base supporting the positive market structure. If the market is going to continue its higher move high, higher move low campaign, any weakness will bottom out above here, right? So where those key market levels to look for, 106, 150, and 60 cents. And then that R level specifically at 104, 284, and 60 cents, right? Those are, if price can hold 108, where do we look to re-engage for the neutral digestion higher or the resumption of the bull trend? 106 and then 104.25. On the strategy side of things, there's a couple things to look at, right? For an optimal strategy theme, this is the optimal place to put risk capital, right? So a buy R fade, which is fading the 104.25 range. So a market that breaks under 108, can't hold the 106, and goes down to 104. This is a break to buy as long as 103.8 or 103.750 holds. If 103.750 holds, the expectation is this market will, this is a buy R fade, which targets right back to 108, right? The next is a buy directional breakout. We had an attempt here off the open, right? This is Saturday night's open, broke down under it, held, rebased this over this positive yellow dash line here. That is a buy directional breakout. If that market's going to hold, it needs to hold positive structure, right? However, the structure break right here puts it more into a digestive outlook, which is more in alignment with that July kind of theme of no real catalyst in the forefront that we can see. Next piece here is we actually just launched the options portion of this. So this is exciting. And you can see that for alpha traders, which is more of a active trader that's looking to engage in the markets, same thing here. So buy calls off the R fade, right? And then a buy call DP reversal, right? So same thing, which is the R reversal here. If we get a break here and then a rebase, as long as we're holding positive price structure, the expectation is a move back to the mid is expected, right? That directional level. And if that does happen, it needs to hold and it needs to go quickly, right? If you're outright long calls, because the reason for that is that premium will decay, right? We're looking at volatility on the 30-day is under a 39. And so that vol continues to bleed and become a problem for anybody holding it. So, some of the insights: the market remains in a bull trend with the R anchored at the DP, forming the structural base of the move. Alpha participants should stay aligned with the trend, leaning into dip buys and confirm breakouts at key zones like the R level, the DP, and the directional, right? So the R and the DP in this context are the same. A sell UP reversal can be used tactically to target a quick APMD pullback to the directional, but this should be treated as a short-term counter trend setup, not a core position. Trend aligned entries remain the focus, right? Because we're in a bull trend, we're looking for breaks to buy as we have tailwind behind us to help support the market, right? If we are looking for kind of a quick scalp on the upside, a sell UP reversal is in play. However, it needs to produce off of a price through 112.500 and reverse quickly under 111.25 and then immediately target 108. If it cannot do that, remember that we are in a bull trend and the outlook then becomes more digestive, choppy higher versus just an outright short, right? Which means if you're long puts, should be out of that premium as that decay will kick in quickly. On the right side, let's take a look at Bookmap. Where's that resting liquidity at? So 106, right? So just exactly what we were talking about. So you have resting bids here in the book at 106. You have a resting bid here at 105,500. So basically in the middle. We don't see much alignment on that side, but 106 we absolutely do for that larger liquidity band sitting there. And then on the top side, 108.5, which is basically these today's highs, right? And so the expectation is that's probably just a resting order in there at the start of a new day. Make sure to check to see if it's still on the offer, to see if they're willing to get filled. Next, let's hop over to Ethereum. Okay, cool. Let me see. Cool. Steven, I see your questions. I will I'm going to answer them at the end after going through the Ethereum real quick. but those are great questions. So let's hop over to the weekly. So a couple things to talk about with the weekly. The R level is directly stationed at the directional, right? What is that telling us? That means this market is ready to go, right? And this market is in balance. So markets in balance can always remain in balance, right? That is a kind of a volatility theme. If a market's in balance, there's no reason it has to go out of balance. The only reason that it would go out of balance is if there was a positive or negative catalyst to push it out, right? However, 250195 is the level to watch over. It's positive both on a price and a sentiment bias, right? And the fact that the R level is directly at the directional, this market's telling us if it's ready, or that it is ready to go, and if a catalyst does come, then that is the expectation, right? And where does that target? The UP, right? But more specifically the UT1 for a quick move to basically 2900. So the market state is a market in a neutral positive shift. So this is a signature state, and it proceeds by a positive technical signal against an underlying negative bias in a non-trend general market state environment. This is a dynamic trade state with the potential for action. Volatility is not expected to increase as much as in a bear trend correction, however, but it is more likely to produce follow-through in the corrective signal direction rather than reverse it. This is the opposite of a bear trend correction signal, which is expected to provide opportunity against the signal in a direction of the underlying trend. Markets in the signature state will typically go with the corrective signal, but not willingly with expectations for a stop and go trade. This market state will provide short-term opportunities early in the session, but is vulnerable to a drop back into a sideways turn as session wears on, right? So this market is telling us that we did have some breakouts early, right? That our breakout, which is that directional breakout early off that Saturday open, right, into Sunday, and then that quick reversion. And then we've been tight in a range, right? So let's look at the structure. Structure with the R level at the directional, there is no bias, right? So technically the market is in a neutral positive shift market state with a momentum balanced, putting the market back on the fence. Opportunity exists on both sides of the market with potential of being a turning point session, right? Let's look at the strategy. So optimal strategies. So a buy R fade, right? So a market that breaks out, comes back down, which is right here, base is over 2501, and then extends, right? So what to look for over the next 48 hours? As long as we held that 2501.95, which is basically in alignment with the previous month's close, it's a positive market, right? With the alignment with the R level at the directional, it's also positive in terms of sentiment, and it also tells us that this market is ready to go, right? So the buy R fade is good for the upside, and then the sell UP reversal basically is that neutral state suggestion, right? So the fact that if we make a play for 2700 but immediately reverse back through it, the expectation is that we could come and retest that mid with basically a nothing going on for the week, however with some range expansion in the meantime. So both sides of the trade exist, right? So on the buy side, right, we priced up and now we're back, so a hold over 2501, targets 2700 roughly, right? I priced through 2700, that immediately reverses, targets right back to 2500, right? And that becomes this sloppy, digestive trade that's really frustrating traders. But one thing to note is we are still longer term in a very structurally positive sense, right? So strategy here, the R level equal to the directional signifies a more aggressive stance to the positive signal confirmation in a hold or fold trade environment. The market is on the fence, and the action of the directional R level is expected to point the way to the next move or a rotational trade around the directional R, right? Use a buy R fade and a sell R breakout strategy to capture a price move away from the directional R level. use the CR plus and the CR minus must be breached to validate. So the fact that we didn't breach it is the expectation that we're kind of just digesting, right? If we can't hold over 2502, it would only be natural that we come down, make a symmetrical swing to the downside, right? Which would be 2406. Again, if we can't break it, it just is a digestive sloppy trade that we've continued to see. Yeah, so Stephen, I see your last question. So specifically here, these are, you can see the strategy side, these are your Delta 1 strategies. So your spot market, perpetual market, futures market. We have an individual tab here for the options. So options here are of their own. And you can see the strategy as well in here, as well as options analysis, insights of the state. So when we go on here and we read them, and kind of how we built this all out was, okay, we start at the market state, right? What is the market state? Market state basically tells us the context of the market. So neutral positive shift, right? So you can come in here and you can read all of that, what that means. It gives you color on that. Then we come in here and we talk a little bit more about the structure of this of the current market, right? So where is that R level in relation to the directional? Where is that R level in relation to price, right? That kind of gives us our sentiment bias. So because of the fact that it's directly stationed at the R directional, that's a no bias, right? Versus Bitcoin had a positive bias, right? And so the Ethereum market is basically on the fence. And so a market that breaks down is not a market to fight. And a market that breaks to the upside is also not a market to fight. Whereas the Bitcoin market, right, had that positive sentiment bias with that R level down at the DP. And it showed that a market that broke down is a market to potentially fight and look for better entries, right? Those entries were stationed at 106, 150, and then 104 and a quarter, right? So for Ethereum specifically, what the structure piece of this is telling us is there is no sentiment bias, right? So this market is ready to go either side. On the strategy side of it, this is specifically to the futures market and your spot markets, right? Your Delta 1 markets. So here it comes with your optimal strategy, your hedge strategy, right? So let's say that the optimal strategy doesn't play out. These are the opposite sides of those, right? What to look for on the opposite sides so that you get both sides of the coin as you're approaching the market and as you're approaching the desk each day. Next piece that we built in was the options piece, right? So this is where you get specifically that options analysis, right? So this is going to be different. It's going to read almost like a book, right? That's kind of why we labeled it the playbook. So it'll be similar, but it's going to have that options color that those Delta 1 markets don't have, right? So volatility aspects, there's some skew aspects in there. There's some other cool things in there as well. And then the last piece is your score. Score is similar to kind of like a tachometer, but it reads where you're at on the price map, right? And where that best area is, right? So the highest level on the score, I believe, is around a 15. And so if you get a 15 reading, that is based on the price map, the best area to deploy risk capital. So that's kind of how we built out the playbook. Okay, cool. So yeah, we can, okay, let me run through the last piece of this and then we'll hop into your question. So it's important to note that Ethereum is on the fence, right? And so it's on the fence. However, it's still in a neutral positive state, right? So neutral positive shift. So the expectation is the market can go, but be aware of that stop and go action, and also be aware of that choppiness, right? The extension in U.S. equities over the last 10 days has been incredible. It seems as if a kind of broader, we're getting some digestion here. So I would not be surprised to see more of a sloppy trade this week versus that linear move. However, over 25.02, that is still in play, right? Where does this linear move really engage? If you get a UP breakout that holds, which is a base over 2,700, which continues to hold, immediately that targets 2,900, and that is the expectation, right? And so if you don't get that UP reversal, which is at 2750, quickly reverts right back down. then the UP breakout's in play and 2900 is in play. Let's hop over here to the Bookmap and just see where that resting liquidity is. So resting liquidity here, sitting right around 2500, so direct alignment here. That's also right around the previous month's close. For a lot of institutional traders, bigger money, that is a very important level to monitor. 2620, right, which is basically right up in here, which is the upside of this, is where you have some more resting liquidity around 2000 coin. So that would be a normal kind of test, right? Seeing these more as kind of a magnet if we can continue to base over this 2500 over the next 48 hours, right? So those are the key areas to look for. On the offer and bid outside of kind of that tighter range, it looks fairly light, but continue to monitor these levels, as we as price moves throughout the week. All right, so that's Ethereum. So let's, Stephen, I'm gonna hop into your questions because you got a lot of them here, and they're really good. So let's go into the last ones here. So and then I'll kind of work backwards after that. So so you said here, still trying to figure out the outlook on the options. So you're going to use options to hedge your futures to play optimal strat. What do you mean by Delta 1 markets, right? So let's start with the kind of definition of a Delta 1. Delta 1 is a linear market. So the best way that I can think about kind of showing that is, let me see if I can pull up. Let's do Greeks live here. Let's see if I can, let's show that here. So I pulled up Greeks live just so that we can go through some examples. Let's go. So I can just show you. I'm a visual learner, so it kind of helps me when I can I talk like this. So you'll notice that the up here I have in the portfolio is one perpetual contract. So you'll see that this line, the slope of this line is linear, or is not linear. It's basically the same slope. So it's y equals mx plus b, right? There's no convexity to it. It is basically just a line that we learn in algebra class when we are in middle school and when we are in high school, right? So it has the same slope all the way across the full price distribution. If Bitcoin goes up $1, we make $1. If Bitcoin goes down $1, we make $1, right? There's no convexity anywhere across the full price distribution. However, so that's your Delta 1 market, right? It has the same delta across the full curve. And I can show that. Let's see. I don't know. I think this is actually priced in coin, so it's not going to be the same. But yes, so the same slope here all the way across full price distribution. Even if I go out to 1,000,000, you see that it's no convexity. So let's trash that and let's put up a call. And then we'll see how the call looks a little bit different than that. Right, and let's do a little bit out of the money. And then let's zoom in a little bit. All right, so you'll notice that this call, right, one call, one December 125,000 call. So this is an option to buy Bitcoin at 125,000 on December 26th of 2025. You'll notice that this call, right, the intrinsic value of this call is this red line, and that has basically a 0, right, the premium you pay up until that strike price, so 125, and then immediately it starts to gain value, right? And based on that premium that we bought, you'll see that 125 all the way up to 135 is where that breaks even on the premium that we bought, and then which is kind of where your volatility matters, but we can talk about that a little bit more later. And then beyond that is where you start making money. However, you'll notice that that delta isn't a 1, right? And that delta at the money is around a half, and then it approaches 1, right? And so at 125, which is right here, you're not a 1 delta. You are a 60, right? A 0.6 delta. And then as we go higher, and that intrinsic value becomes more embedded into it, right? Then it becomes more like a future, which is close to that delta 1, right? But another thing to note is you have this convexity, right? And so this convexity in this green line is that extrinsic value. So if volatility goes up, which I can show right here, you'll see how that had a direct impact to that green line. And if volatility goes down, you'll also see that here, right? And so options are not delta 1 because they're a bit curvy, right? And so they don't have that linear slope, whereas they have convexity, right? And you can see that in some of the Black-Scholes formulas or some of the pricing models. So when I talk about delta 1, I'm talking about any of the products that mimic kind of that payout of that future, right? So that would be a perpetual future, that would be a spot market, that would be an outright future, right? A calendar future. Those are all going to be, yeah. And so you said because of vol and time to expire. Yeah, exactly. So you can think of an option as I think of an option as a bell curve, which is a price distribution. And so the at the monies is flip a coin. It's 50-50, right, on that delta. And then that bell curve essentially gives you that full standard deviation, right? So 1 standard deviation away from price, 2 standard deviations away from price, and then 3, and so on, right? And that's where you get those sigmas that come into play, right? So a sigma is a standard deviation. It's a little bit more of a technical term, but all of those things are priced into that options contract. And that options contract, basically the premium which you pay is basically the probability that the market is currently pricing in that will go into the money, or what that options contract is worth, right? And so as volatility goes up and as volatility goes down, that bell curve expands and contracts, and that's where you get that differing in prices and those differing in deltas as they change. And then back to your question on options to hedge your futures, play optimal strat. Yes, that's a little bit more advanced. So that is covered a little bit here in the playbook. There are some optimal themes that do have some short volatility setups that are paired off delta, which is really interesting. Those are really good ways that pros approach markets. Right, by leaning on the skew, leaning on the vol, taking in that risk, and then offsetting it with deltas. And so a lot of institutional traders are using that to harvest vol and harvest that vol premia. Yeah, so your comment says, I've been learning a lot about spot gamma option stuff, not been putting my focus on strategies, understanding the risk profiles, etc. to round off my understanding, but one step at a time. Yeah, options are complex. There's a lot of things in which you can build with them. And they give you a full range, right? And so when I say full range, basically there's an option for 1800, which is all the way down here when price is up at 2500, and there is an option for 4000, right? Now, on a weekly basis, those 4000s are basically zero, right? Because the market's already priced out that expectation. But it gives you more versatility when you are taking a look at probabilities over a full distribution. And then, yeah, some of your questions above, I'm going to run through those. So can you go over this again? Over the weekend, I was studying how crypto options work and how it's structured, short covered puts. Can you demo how you would put a buy at 104K with options? Curious how you would do this. Yeah, let's actually run through that. One thing to note is let's make sure that options are interesting for a lot of different reasons. One of them is volatility. And so when you take a look at putting on a short option, you'll notice that the risk reward is skewed against you. Part of the reason for that is because most options actually expire at 0. And so volatility selling is a very good strategy historically. However, during specific volatility regimes, and it all matters. So if we zone out to all, this kind of gives us, I'll blow this up so that we can see this on YouTube, but if I scope all the way out, zoom all the way out to all, and then I get down the 7-day, one thing you'll notice is that the 1 month volatility on the 30-day, right, which is the at the money implied vol on the 1 month tenor is right around a 36 here, but I'm looking at Deribit right now live and it's at 38.60, so right around this price. Historically, this is a very low price for volatility, right? And so what I would actually do when approaching that 104 buy is I would put on outright calls. And the reason for that is because the expectation, based on what we talked about, was that bounce right back, right? And it kind of goes into the respect of what we talked about, where we were talking about convexity and how options are used. Options are great for their asymmetry and their asymmetrical payout. So sometimes when you bet 1, you get 10, and risk reward is skewed in a big way. When it matters is when you add all of the pieces together, right? So this is all theoretical, right? Price has to hold here, but this is exactly what I would look for at 104, right? We know volatility is low historically. We know that market is still in a bull trend market state, which means we are looking for levels to buy. Where's the best level that we deem to be bought? 104.25, right? If it holds, what am I looking for? I'm looking for the best risk reward, right? And part of that comes from capital efficiency, right? So instead of risking an over levered position on spot, right, I can come in and I can buy an out of the money call, right around 106 or even right back around 108. And that price is going to be significantly lower and the payout will be significantly higher, right? And so if you get I'll just do a rough price here for you, just to kind of run through this real quick. You got a delta on here of 50. If we drop by basically 4,000 points, and let me bring the calculator over here to show you these rough calcs. That's going to be 2,000 points off the premium, right? So that July 11, if we're looking at that same call, oops, apologies. That is the wrong price. So you're buying it back cheaper. Yeah, so sorry, I was reading your question. Yeah, so if price drops all the way down to 104, you'll notice a significant decline, right, in these calls, right? And so you can actually risk significantly lower and still participate. I would actually look more towards the 106 area personally. The reason for that is these are 7-day options. volatility bleeds. If you don't really get a reversal, those 108s are going to continue to decay at a pretty rapid rate. So that matters significantly. Being a bit closer to the money, and especially shorter dated options, helps if you're going for a play higher, especially in a market that that may digest as well for the remainder of the week. So for a quick scalp, that works. And then I'm going to read the rest of your question here. So you can both take a sell, short, a put at 104, and you can buy a long call at 104. How do you decide? Yeah, so I actually wouldn't sell the 104 puts. The reason for that is because volatility is so low right now. It's just kind of a matter of time before it goes higher, right? And how does it go higher? There's a couple of reasons. One, we need an expansion of range, right? So just because we're in a bull trend, that doesn't mean that is the golden egg, right? All of these tools are here to help identify where that risk is and where that best outlay of risk capital is, right? So 104 does not have to hold. However, that is exactly the level that we're looking for as the optimal place to deploy risk capital, right? So deploying risk capital at 104, stopping out at 103,800 is only a 200 points risk, right? Versus a market that is under 108, right? As long as it's under 108, there's no real rush to get engaged with this market. 104 and a quarter is where we're looking to engage. And that it helps us on two folds. One, it helps us not overtrade. And two, it helps us not hold on to risk or hold on to a thought process that we are right when the market's clearly telling us we're wrong, right? So if that market breaks under 104, those short puts are going to explode, right? Because this immediately then becomes a hedge theme, right? And that hedge theme is not a market to buy. And if you're selling puts, you're actually buying spot. It's weird to think about. However, if you're selling the right to short the underlying, you're buying the underlying, right? And so that short put actually has a positive delta. And that positive delta will explode from a 25 delta to a 60 delta, which will increase that premium. And you'll see significant losses immediately, right? And that's not a great place to be with volatility this low. If you're looking, if you're looking for the best risk reward, 104 and a quarter holds. I'm looking for convexity. Where can I go to the market to get convexity? Sure, I can go to the spot market. I can take a 3-to-1 kind of leveraged position, and absolutely I can trade it. However, potentially the spreads in the spot market, potentially the churn of just managing that spot market is going to have a significant cost, right? Let's say I risk 5 bips of the portfolio to make 25 bips on the month, right? If I spend all of that in churn, now I have to take the same amount of risk just to participate. And let's say the market takes a little bit to rally. The options contracts allows you to have that leverage without paying as much, right? Especially in a low volatility environment. Lower volatility, you get that convexity, right? The market's not really pricing in a large range to happen. And so if you're a buyer and it does happen, you're getting it cheap. If there's high volatility, that's a different situation, right? If we're in a bull trend, there's high volatility. Let's say we just came back off of a kind of a rally, and then we broke, and then the market's digesting this rally, and there's higher vol. That's a market that you can fade some of that downside premium, and even use some of that premium in the form of a bullish risk reversal to finance some of those calls. So there's some cool things that you can do, but specifically to answer your question, yes, it's all on volatility. So if I'm looking at selling a put and I only get $100, but my risk is $1,000, that doesn't make a lot of sense. If I can buy the call for $100 and get the reward for $1,000. it's a bit more nuanced than that, but general rule of thumb, volatility when it's cheap, it's like picking up pennies in front of a steamroller. Yeah, I mean, if these questions are great, so if you have any more questions, even if we're not on the weekly stream, drop them in here and I can answer them, or we could just hop on real quick and I can go through some too as well. So, thanks for dropping them in. All right, cool. 4 minutes to 4 here in Chicago. So let's wrap it up, and then for anybody that has questions or anybody that's not in the Discord, make sure that you're in the Discord and answer. I'll be in the Discord pretty frequently answering questions. So I will catch you all next week.